Empirical Asset Pricing, the cross section of stock returns, is a comprehensive guide that delves into the methods, models, and empirical evidence in the field of asset pricing. Focusing specifically on cross sectional stock return variations, this book examines the underlying factors, econometric techniques, and statistical analyses that explain the differences in returns for various stocks. Here's our pick of top 10 insights from the book. 1. Despite advances in finance, empirical asset pricing shows that markets are inefficient and anomalies persist. The paradox of market efficiency, akin to spotting a unicorn at the stock exchange. Empirical asset pricing takes us on a safari through the wilds of the stock market, highlighting that anomalies prance about like mischievous pixies, eluding the grasp of the efficient market hypothesis. While we've sharpened our financial acumen, markets still snicker at our efforts to tame them. It's like playing whack-a-mole with invisible moles. You know they're there, causing ripples in your neatly planned investment garden. But every time you think you've got it figured out, surprise, they pop up wearing a new hat, chuckling at our so-called advances. 2. Traditional asset pricing models struggle to explain the cross-section of stock returns, suggesting a need for multifactor models. The perplexing puzzle of predicting stock returns. The financial wizards with their traditional asset pricing cauldrons have toiled and troubled over bubbling brews of KPM and single-factor models, only to find that the potion lacks the predictive punch. Enter the multi-factor models, strutting on the Wall Street stage with a swagger, boasting a buffet of factors like size, value, momentum, and even the kitchen sink, all to capture the elusive essence of stock returns. It's the investment equivalent of a superhero team-up, where instead of capes, they're sporting spreadsheets, ready to vanquish the villain of volatility and rescue your returns from the jaws of inadequacy. Spoiler alert. Even the mightiest multi-factor model may trip on the unexpected banana peel of market madness. Stay tuned. 3. Behavioral biases play a crucial role in asset pricing and can lead to systematic mispricings that shrewd investors can exploit. Ever witnessed a horde of lemmings leaping off the cliff of rationality? Well, investors don't exactly line up for a synchronized swan dive into the abyss, but their behavioral biases often nudge them off the ledge of logical investment decisions, giving birth to deliciously mispriced assets. These behavioral quirks, think of them as financial Freudian slips, can distort the true value of securities, creating a wonderland for the keen-eyed investor who can spot these cognitive bloopers. From overconfidence to herd mentality, the market is a veritable zoo of biases. And for the investor who knows their behavioral ABCs, each mispricing is not a market malfunction, but an invitation to the buffet of opportunities. Bon appetit, smart investors. 4. Liquidity is a significant but often overlooked factor that can explain variations in stocks' expected returns. Liquidity is like that unassuming friend who doesn't hog the spotlight at parties, but somehow ends up being the person everyone relies on to get home. Similarly, in the stock market, liquidity might not get the glitzy headlines like earnings or market crashes, but it's absolutely crucial. Picture this. You're trying to sell your vintage action figure collection, read stocks, at a garage sale. If buyers are scarce and hesitant, you might have to lower your prices to make a sale. Welcome to the world of illiquidity discounts. In the grand bazaar of stocks, assets that are easier to trade without affecting their prices, more liquid, are like the cool kids. They demand lower returns to chill with them. On the flip side, less liquid stocks are the loners and need to offer a higher return to attract investors. So liquidity is not just a matter of convenience. It's a powerful factor in deciding the potential profitability of your investments. Watch out for it, or you might find your portfolio feeling a bit parched. And 5, empirical evidence supports the momentum effect, where stocks that performed well in the past tend to outperform in the future, which contradicts the efficient market hypothesis. All right, let's dive headfirst into the stock market's version of the rich get richer, the momentum effect. It's like that friend who keeps winning at Monopoly. You roll your eyes, but deep down, you want to know their secret. Stocks strutting their stuff today have a knack for sashaying right into the future, flaunting gains and leaving the efficient market hypothesis, EMH, in baffled silence. EMH is like the straight laced guy at the party insisting, it's all random, folks, while momentum is the life of the party, proving with a wink that some dance moves predict the next song on the playlist. It's not just Wall Street gossip. This is empirical evidence winking back at us. Invest in the past's winners, and you might just be popping the champagne tomorrow. Cheers to the contrarian streak of stock trends. To sum it up, the book Empirical Asset Pricing, the cross-section of stock returns, illustrates the limitations of traditional asset pricing models and acknowledges the role of behavioral biases and factors like liquidity and momentum in explaining stock returns. It underscores the complexities of financial markets, offering insight into how investors might exploit inefficiencies in pursuit of better investment strategies. Thanks for watching, and I hope you found the summary insightful.